Hello, my friends. Today I have Ling here who will go over how to utilize depreciation on your rental property for a tax advantage. If you have rental properties or plan on eventually owning a rental property or 2 or 10, then you'll want to take copious notes as you watch this video. Now, before we begin, remember, the information shared in this video is for educational purposes only. All contents are based on personal knowledge and experiences only. It should not be used as tax advice. Make sure to consult a tax professional before you make any decision or taking any action on your own situation. Let's go, Ling!
One of the reasons why real estate investment is so attractive is because rental property, if you do it right, can provide you with huge tax advantages. If you watched my last video related to the 4 income streams from real estate, you may remember income stream number 4 talks specifically about tax savings. Depreciation is one of the tax strategies that you can use to potentially generate a passive loss, which may help reduce your taxable income. Before we dive into the detail, let's first talk about the difference between earned income and passive income. They are treated very differently by the IRS. I will take myself as an example. I'm still working for a company, so my employment income, such as W-2, wages, salary, or a commission, are considered earned income. If you are self-employed and work for yourself, any business income that you generate from your self-employment is also considered earned income. Passive income is earnings from rental properties, limited partnership, or stock dividends. In general, the person is not actively involved in the day-to-day operations. The reason why you need to understand the difference between earned income and passive income is if you happen to generate a passive loss from your rental properties, there are strict IRS rules on how much passive loss you're able to use to offset the earned income. If you haven't watched my last video related to the 4 income streams from real estate, please check it out on my channel. And let's first refresh income stream number 4, tax savings. We talked about, in addition to the normal operating expenses that you're able to use as deductible, there is also a concept called depreciation. And for depreciation, if you are a non-real estate professional and your adjusted gross income is less than $100,000, you are actively participating in the rental property business, you are able to deduct up to $25,000 in passive loss. We'll focus on 3 topics. Number 1, the basic foundation of depreciation. Number 2, who is qualified to be a non-real estate professional? And number 3, the IRS rules on maximum passive loss you can use if you are a non-real estate professional. Let's dive right in. When you purchase an asset, in order to help you recover the capital expenses, IRS allows you to take a deduction over the expected life of the property. And for residential real estate, the recovery period is 27.5 years. What that also means is you're able to take the depreciation and reduce your taxable income, although this is a paper loss on tax returns. There are a couple things to watch out for. Number 1, you can only depreciate the improvement and not the land. So for example, if you purchase a single-family home for $250,000, if the land value is $50,000 and a property value is $200,000, the depreciation can only be calculated based on the $200,000. And if you use $200,000 divided by 27.5 years, that means you're able to deduct $7,272 as your depreciation for that home on the yearly basis. The second thing to keep in mind when you do decide to sell the property is you have to pay the depreciation recapture tax. There are strategies to defer the capital gain tax as well as the depreciation recapture tax by leveraging 1031 exchange. I created a separate video for 1031 exchange. Please check it out if you are thinking about selling a property. And there are other strategies related to depreciation, such as cost segregation analysis or bonus depreciation. We're not going to talk about those in detail here. Please leave me a comment if you wanted to understand more how those work. Now let's move on to the second topic, non-real estate professionals. Non-real estate professional is someone who's actively participating in the rental property business. And if you have met the two below conditions, you are then considered as actively participating. Number one, you own at least 10% of the rental property. So if you and your spouse owns the property 50-50, then you have met the 10% rule. Number two, you're also making management decisions. Although you may not be doing the day-to-day operations, but if you are reviewing rental leases and deciding on rental terms, approve applications, that means you're making management decision. So in summary, if you own at least 10% of the property and you're making management decisions, you are considered a non-real estate professional. For most of us smaller investors, it's fairly easy to be qualified as non-real estate professionals. And if you do generate a passive loss from your rental property, now next let's take a look at IRS rules on maximum passive loss you're able to use to offset your earned income. The IRS rule is based upon your adjusted gross income. If your AGI is equal or less than 100,000, then you're allowed to deduct up to 25,000. If your income is between 100 and 150,000, what you would do is take the amount that's over the 100,000 and multiply by 50%. For example, if your adjusted gross income is 125,000, you would use the 25,000 multiplied by 50%, which equates to 12,500. Then that is the maximum passive loss you're able to use to offset your earned income. If your AGI is more than 150,000, then you are not able to take any loss at all. Hopefully by now you have a good understanding of what depreciation is and how to qualify as a non-real estate professional, as well as the IRS rules on the maximum passive loss you're able to use to offset your earned income. Now let's put all the knowledge together. For this example, let's assume the initial capital expense to purchase a home is $250,000. We're able to rent it out for $2,000 per month. So the yearly rent, that cash coming in, is $24,000. In the cash out column, it lists out all of the operating expenses, what's paid out. Let's put the depreciation aside. At the end of the year, since you have made a profit of $6,680, this will become a passive income that you have to pay income tax in addition to your earned income. Now let's consider the depreciation. And we use the same assumption where the land value is $50,000 and building value is $200,000. We then use a $200,000 divided by 27.5 years, which equates to $7,272 as our annual depreciation deduction. What you would do is to deduct $7,272 from your annual profit of $6,680, which equates to negative $592. And that now has become your passive loss. Now let's take a look at three different adjusted gross income scenarios and determine how much passive loss you're able to use to offset your income. The first scenario is your AGI is at 95,000, which is less than the 100,000. In this case, you can deduct up to 25,000 in passive loss. And since our passive loss is only $592, then you can deduct the entire $592. The second scenario is your adjusted gross income is $125,000, which is in between $100,000 and $150,000. In this case, you are able to deduct up to $12,500 passive loss. And since our passive loss is less than that amount, you're able to deduct the entire $592 again. The last scenario is your AGI is at 155,000, which is greater than 150,000. In this case, because your income has exceeded the maximum income level, you are not able to deduct anything for passive loss. And therefore, your taxable income will remain as $155,000.
Okay, thank you, Ling, for sharing your knowledge related to depreciation for rental properties. I can see how this can be a valuable financial strategy to pay less taxes and keep more of your hard-earned money. Folks, if you find this video helpful, please subscribe to this channel, hit the like button, and share with anyone who may also benefit from this knowledge. See you all very soon. Bye.